You know, it took like 39 seconds using ChatGPT's newest model to figure out the 11 best rental markets in America. And back in the day, we used to have to just like do a ton of research. I mean, go visit the city, look up a million different websites to really find a good market. And still, we weren't too sure. If you have rent of $1,500 a month and your mortgage, taxes, and insurance are $1,200, you are not making $300 a month. You're probably losing money. Why? Because of things like repairs, maintenance, vacancy, and CapEx. In 2025, like, it's hard to find good deals. It's really hard. In today's market, you don't find good deals. In today's market, you make good deals. We actually make good deals by value add. The cool thing they did here is ChatGPT actually recognized, are we talking cash flow or appreciation or both? So they actually divided the list of 11 best markets into 3 chunks: cash flow heavy, balanced growth and cash flow, and then high growth potential. I actually know quite a few people who are invested in Alabama, and I think that is a fire market that is underlooked at. I think 100% right. That's a great place to look. I've got a bunch of properties in Texas. Where Texas sucks, our number 1 market also happens to be in. My name is Brandon Turner. I'm a real estate investor now for almost 20 years. I've got almost 14,000 units across 20 plus states. And back in the day, we used to have to just like do a ton of research. I mean, go visit the city, look up a million different websites to really find a good market. And still, we weren't too sure. Now with artificial intelligence, it's wild. In like literally less than a minute, it ran this amazing report on all the best markets, what makes a good market, all that. So I'm gonna share all that with you today. And you can go play with it on your own using ChatGPT later. And by the way, if you find this helpful, if you like rental properties, you want to do all that, give me a little like thumbs up below the video. Let the internet know this is good. And with that, let me get into how I did this. So I want to start with how I prompted it. I promise I'll get to the 11 markets in just a second. I want you to know how I prompted this too, because otherwise, if I just said best markets, you're like, well, what does that even mean? I actually used ChatGPT to help me figure out what I was then going to like decide as a good market. In other words, I asked it. So here's the prompt I gave it. You ready? I said, help me pinpoint the best US markets for rental properties. Number 1, start by listing 5 key indicators of a strong rental market. So I care about the economy of a place, obviously. Second, tell me the 5 key indicators of a great rental property. So like, what would I even want in a property? What makes a good rental? And number 3, I said, then using those indicators, analyze markets nationwide and recommend the top locations. And I pressed enter. And literally, actually, I think it was 2 minutes and 20 seconds later, so it took a little bit of time, it came up with the 5 key indicators of a strong rental market. It started there because that's what I asked it for. And here's what it decided. This is what ChatGPT, artificial intelligence, thinks is what makes a good market. Number 1, population and household growth. Number 2, job creation and economic diversity. That's really 2 different things, but they combine it into one. Number 3, affordable price to rent ratios. It means that if a property, the price is whatever, $200,000 and the rent is $2,000, that's a price to rent thing, right? That's like the 1% rule. But if a property is $200,000 and it only rents for $1,000, that's like 0.5%, right? So that's price to rent ratio. Also, low vacancy. They want an area that doesn't have a ton of vacancy because that's a problem. And then finally, landlord-friendly regulation and taxes as well. Huge. So those 5 things, actually, I think they nailed it perfectly. I don't think I would add, I mean, there's obviously a thing we could add to it, but in general, those are the big 5, and that's what I would choose. So again, we're on a good path here. Let's keep moving on down the page. What else? Because remember, I asked it to do 3 things, right? The key indicators of a market. Then I asked it what makes a good rental property, and then finally, the best market. So what makes a great rental property? Here's the 5 indicators, and I actually don't agree with one of these necessarily. It's nuanced, and I'll get to it. First, this is the one I don't agree with. True cap rate greater than 6%. The reason I don't like it is because nobody uses cap rates when it comes to residential properties. I use cap rates when I buy multifamily and commercial properties and mobile home parks. Cap rates, essentially, they're much more designed for commercial. Yes, they technically work for residential, but nobody talks about them. Instead, how I would translate that or pivot it is just simply, does the property make mathematical sense? That's the most important thing when it comes to rentals, or at least one of the top 5. Does the property actually make money? And so many people screw this up. There's a difference between a thing I call phantom cash flow and pure cash flow. And so phantom cash flow says, hey, what is the rent minus the mortgage? That's my cash flow. No, that's phantom. That's fake. It'll never show up. It's not real. If you have rent of $1,500 a month and your mortgage, taxes, and insurance are $1,200, you are not making $300 a month. You're probably losing money. Why? Because the things things like repairs, maintenance, vacancy, and CapEx. Now that's a little beyond the scope of this video, but I do want to encourage you to dig into the world of what does it mean to actually run the numbers correctly and determine what's going on. So to help you with that, if you want, I have a free 5-day challenge that I give people on how to analyze deals better. At the end of it, you'll be better than 99% of people at analyzing properties. Like literally, it's just every day for 5 days, you're gonna learn another aspect of how to analyze correctly. If you want it, just go to abetterlife.com/challenge. That's it, abetterlife.com/challenge. All right, moving on. So number one, they said basically the math has got to work. I agree with that. They just said cap rate. Number two, neighborhood fundamentals. I agree. I'm going to only want to buy a rental property in an area that I like. My rule of thumb is if my wife can't jog there in the day, I don't want to buy there. Number three, mechanical and structural soundness. Like I want the property to be in good shape, or I can at least put it in good shape if I need to. That one, I agree we need to, but I don't think they should like exclude properties that are nasty or old, because we just got to fix them up. It's just part of the strategy. Number four, value add or rent growth lever. Oh, huge. In this year, like I'm recording this in 2025. I don't know when you're watching this. Let me know in the comments when you're watching this. But in 2025, like it's hard to find good deals. It's really hard. In today's market, you don't find good deals. In today's market, you make good deals. We actually make good deals by value add. So for example, you could buy a 3-bedroom house, add 2 more bedrooms to it because there was a second living room, and all of a sudden you have a 5-bedroom house. The 3-bedroom house rents for $2,500. The 5-bedroom rents for $3,500. By adding in that extra couple rooms, you've now increased the value, the cash flow, and the actual value of the property. Same is true for like flipping houses or doing the BRRRR strategy. So again, I love that one that ChatGPT said. And finally, the last one was exit liquidity. Property lies in a price band and area with steady buyer demand, so you're never stuck. I think that's probably pretty important too. If you have a weird property in a weird area that's hard to sell, you're kind of stuck. You can't access your liquidity when you need it. And so I maybe wouldn't put that as like the top of my list, but I think it's certainly an important piece of a rental property. But honestly, the thing that matters most for me is, does the math work and is the neighborhood good? If you get those two things, and maybe I'll add one more thing, is are there good property managers in the area? Like if you're out in the rural area, countryside, it doesn't matter how good your math works, like it's gonna be hard to manage unless you do it yourself. We gotta move on. Let's talk about the 11 markets. Now, the cool thing they did here is ChatGPT actually recognized that when you say like, what's the best market? Even ChatGPT is like, well, what do you mean by that? I mean, we talked about all this stuff, but are we talking cash flow or appreciation or both? Cash flow meaning extra money in your pocket every single month. Appreciation meaning the value goes up over time. So is it cash flow that we want, or is it appreciation that we want? Or is it both? Is it a mix? So they actually divided the list of 11 best markets into 3 chunks: cash flow heavy, balanced growth and cash flow, and then high growth potential. I want to start with the high growth potential. We're going to work our way down from 11 down to number 1, but we'll start 11, 10, and 9 are going to be the high growth appreciation plays. Doesn't mean you can't get cash flow in these markets, but these ones, ChatGPT says, we think this is going to be hot in the future, and so it's a good place to bet long term if that's your strategy. Coming in at number 11, we've got Jacksonville, Florida. Why did it put on the list? One little point and said it, why it stands out. It just topped 1 million residents. It got diversified port and logistics economy, and it's a landlord-friendly state. Okay, so that's good. Number 10, Dallas, Fort Worth. Added 52,000 jobs over the past year. That's the largest gain of any metro, and there's just relentless immigration there. And that's not a political statement. That's literally what it says here, relentless immigration. So we got a growing area with lots of new jobs coming in. Dallas, Fort Worth, long-term, powerful. Number 9, Raleigh, Durham. Am I saying that right? Raleigh, Durham? I've never said that out loud before. I've never been there. Raleigh, Durham, North Carolina. Research Triangle Tech Engine, 14.7% 5-year job growth. State corporate tax headed to 0%. Interesting. I did not know that about North Carolina, but very cool. When a state does stuff like the corporate tax dropping down, why do they do that? They want to incentivize growth, business growth. That's great. I got some friends actually that do invest in the area and they seem to love it. All right, so we got 11, 10, and 9. Let's go to number 8. These 8, 7, and 6 are all the balanced markets. They're kind of potentially appreciation and cash flow. So number 8, Memphis, Tennessee. They said FedEx and a logistics center. It's got robust cash flow and a stable blue-collar demand. I know Memphis has been a powerhouse for a long time, but it was always considered a cash flow market. It's only the last few years that really they've been looked at as a appreciation play as well. Next one, Kansas City, Missouri. Vacancy rate is falling as household growth outpaces new builds, and there's moderate prices. That's right, my buddy Cam Cathcart invests in Kansas City, Missouri. Kills it there. I know there's some really good prices. That said, and this is just this is maybe a disclaimer over this whole list, this is big markets. you can't just buy in a big market, right? So there are great areas of Kansas City. You can buy $1 million house in Kansas City, and you can buy a $10,000 house in Kansas City. It's probably true about Memphis as well, and all the rest of them on this list. You can go big, or you can go cheap or expensive. There are good areas, bad areas. So a market's not enough. We also need to know submarkets, which I bet we could use ChatGPT to figure out. All right, next, 6, Indianapolis, Indiana. Midwest logistics hub. Rent to price, it says, is 0.65%, so a little bit below the 1% rule, but fairly high compared to most places. And a solid 5-year job growth. Yeah, I actually have quite a few friends that invest in Indy. I have some mobile home parks right outside Indy, so yeah. I definitely like that market. Moving down, we got top 5 here. These are all the cash flow heavy markets. So according to ChatGPT, these are not necessarily high appreciation plays. I generally think appreciation is going to hit everywhere over the next few years, I believe, because we're going to have a housing shortage in the next few years. They're just not building enough right now because of interest rates. So anyway, that's a whole different conversation. Coming in at number 5, Cleveland, Ohio. Why Cleveland? ChatGPT says it's a healthcare and biotech anchor, like the Cleveland Clinic. It's got high yields and improving population trend in Cleveland. Number 4, Detroit, Michigan, up in Wayne County. I had a property in Detroit. I hated it. It was actually outside of Detroit a little ways, out in the suburbs, but yeah, I had a rough property there. Just hard government. That was the problem with Michigan for me, was the government was a little bit too anti-landlord. Not a little, a lot anti-landlord. But again, that was out in the suburbs, different county. But according to them, Ford and GM are retooling a lot in their spend there. Real estate values are far below the peak, so you can still get some good deals, and it says 10% plus yields. So next one, Odessa, Midland, Texas. Energy boomtown with cyclical upside and double-digit yield. Texas ranks landlord friendly. That's true. Texas is a very landlord friendly state. That said, here I've got a bunch of properties in Texas. Where Texas sucks, this is why I talked about pure cash flow earlier. This is why this matters so much in running the numbers correctly, because Texas has ridiculously high property taxes. I have a $3.5 million house in Maui. My taxes are cheaper than a $200,000 house in Texas. It's absurd how high Texas can be. So if you don't run the numbers correctly, if you just look at like prices versus prices and the different expenses, you can end up buying a property that you shouldn't buy. So run the numbers. But again, I do know people that invest in Odessa and they really like it quite a bit. Moving on to number 2, Mobile, Alabama. Is it possible to say that without a Southern accent? Alabama. We're all like trained from Forrest Gump to go Alabama. Deep water port drives logistics, jobs, still inexpensive entry prices, plus landlord-friendly laws. I actually know quite a few people who are invested in Alabama, and I think that is a fire market that is underlooked at. I think they're 100% right. That's a great place to look. And in fact, our number 1 market also happens to be in Alabama, Birmingham, Alabama. Southeast manufacturing hub, steady population, and one of the nation's highest projected 2025 gross yields. According to ChatGPT, 13.6% gross yield. So those are the top 11. We've got, let me recap, Jacksonville, Dallas, Raleigh-Durham, Memphis, Kansas City, Indianapolis, Cleveland, Ohio, Detroit, Michigan, Odessa, Texas, Mobile, Alabama, and Birmingham, Alabama. That's it. What do you think? Let me know in the comments below. Are those good markets for cash flow? If you're looking for cash flow, go check them out, and I will see you in the next video. Subscribe if you like real estate investing content and you want to learn how to build wealth through real estate without sacrificing and losing your soul. I'm Brandon Turner, signing off.